So welcome everyone. Welcome to the Securities Lending Workshop. And we are very glad to have all of you here. And by the number of people, we can definitely see that securities lending is a huge niche, but it's hidden from the public. Because there are not a lot of people here to listen. But I think those who came will not regret. So by way of introduction, my name is Michael Lobanov. I'm a partner of Target Global. We're an international VC firm with offices in Moscow, Berlin, Tel Aviv, and San Francisco. And I was on my own in previous life, before doing venture capital. I was doing asset management. And I was overseeing approximately 200 million of assets. And I was always looking, how can we monetize them better? And I knew we can lend them out. And I knew we can earn at least 1 to 2% per annum on them. And at least make back our management fee and distribute it to our investors. But unfortunately, we were too small. But 200 million is by no means small. But we were, in terms of the industry. And then back in 2015, I had a plan of ShareGain. I had a pitch from ShareGain coming to my table. And I thought, oh God, that's exactly the thing that I was missing. And we are proud to be one of the first investors of this company and one of the first backers of Mr. Boaz Yaari, who will give you a presentation about ShareGain. And Boaz, please welcome Boaz. The floor is yours.
Thank you. Thank you, everybody. So, ShareGain. ShareGain is a part of what I call a capital markets fintech, and we're dealing with a niche in capital markets that's called security lending, but it's a $2 trillion niche. So let me start with the beginning. As we know now, thanks to the sharing economy, we always knew that we can lend out. We can lend out our money. And thanks to the sharing economy, we can lend out our homes, we can lend out our cars. But did you know that we all have the right to lend out our stocks, bonds, and ETFs as well? And not only are we allowed to, and we have the right to lend them out, we also can do so while retaining full economical rights, dividends, and so on, and enjoy from their appreciation. When someone hears it from outside, it sounds quite novel and quite fresh idea. But in fact, in capital markets, there's a 40-year-old ecosystem called securities lending that does exactly that. What are we doing? We took this $2 trillion industry and thought to ourselves, how do we democratize it? How do we enable access to private investors? How do we make private investors actually optimize and maximize the assets that they already own? And what we're doing basically is we've developed a platform. We develop a platform whereby private investors can lend out their portfolios. But what are the problems with the existing ecosystem? Well, the existing ecosystem, even though, as we said, you and I have the right to lend out our portfolio, the practice has been confined to the institutional world. And because it's been kept like a closed members club for so many years, it hasn't been really able to keep pace with the levels of automation and standardization that swept through capital markets. So today we're left with a 40-year-old ecosystem, more or less, that still very much operates like it did 40 years ago. Relationship-based, most trades are done over the phone, very opaque in terms of transparency and supply, and moreover, infested with laborious processes that are driven by systems that were designed 15 to 20 years ago. Now, how did I even get to know about securities lending? Well, more or less I was a part of this ecosystem. I was a portfolio manager and a few top-tier hedge funds back in London. And I came to know this ecosystem and very quickly got frustrated by it. And when I started asking questions, maybe it's the Israeli nature of me, I started asking questions, but when I didn't get really a good answer, I rolled my sleeves and dug into the nitty-gritty of this ecosystem. And when I thought I found the problems, or understood the problems, and couldn't find a solution, we said to ourselves, let's go and build one. For long-term investors, or for private investors that are not what we call day traders, we think that ShareGain is very much a pure alpha story. Why is it a pure alpha story? Because it enables you, firstly and foremost, to generate revenues, new stream of revenues on assets you already own. That's easy. Secondly, you retain full economical rights, about the right to vote on these assets. So you're basically not forfeiting anything. Thirdly, in terms of liquidity, what we call most trades are being done on an open-end basis, i.e. no return date. But you can, as a lender, recall your stocks, and within 2 days, standard settlement, 2 days here and 3 days in the US, you get the stocks back. So the cost of opportunity, if you will, is those 2 days. And lastly, and this is a very important bit, every trade in securities lending is over-collateralized, up to 105, 110% of the value of the loan. That over-collateralization is a key factor in securing the trade. And the beauty of it is that you don't have to do it, we do it for you. What we've done in ShareGain is we've created understanding that securities lending is very much ancillary to what we do. Sounds great, but we don't have neither the time nor the expertise to actually do it and trade it on a daily basis. So we went along and built the first virtual agent lender. What does that mean? It means that we're not a bank or a broker with an app. You don't have to transfer money to us. You don't have to transfer your stocks to us. We act like an add-on feature to your account, like a bolt-on. So once you bolt to ShareGain and we are integrated with your bank, and you define the lending framework, which is ticking of a box and a sliding of a few scales, then ShareGain kicks in, comes alive, and operates continuously in the background, optimizing the portfolio for you. But the beauty of it is that you retain full control and transparency from your mobile or from your desktop dashboard. You can choose who you lend to. You can choose, how much you want to lend. You can choose the term. You can choose the minimum lending rates. Everything is fully customizable. We don't presume to say what you want to do, but when you say what you want to do, we do it perfectly for you. Who do you lend to? Well, you lend to currently banks. Tier 1 banks that are looking to tap into that supply. And that supply for them is very lucrative. Now, as a whole, people ask, and Mike, and I were always talking about it, how does ShareGain fit into the sharing economy? And we think it fits perfectly, and it's exactly the right timing in life, in what we call asset lifetime, that one should use ShareGain. Why? Because we're very much used to now trying to maximize our money through peer-to-peer lending, trying to maximize cars through Ubers and Lyfts of the world. But most of us fail to realize that we have a third asset, a financial asset. It's our portfolio. And our portfolio, we currently enjoy from 2 values, their appreciation and some periodic installments, dividends, coupons. But we're failing to monetize the third value, which is the ability to lend it out and enjoy from rent, if you will. And that value, by its definition, has been, through ShareGain, has now been open. We deliver that value for you and help you monetize it as well. ShareGain, as we said earlier, it's all about understanding that in this day and age, you can't have over-complexities. So we took a very complex ecosystem run by Wall Street. We reversed engineered it, took a lot of the complexities out, and streamlined a process that is simple. There's a great saying that says, if it's simple, it works. If it's not simple, it will simply not work. And what we've done is we created a process, an experience that for a private investor, be it retail, be it family office, a small asset manager, ultra high net worth individual, whatnot, can actually understand what they're doing. understand what they're doing in a simplistic way, but can remain as passive as they wish to the process, without having actually the need to be active about it and make investment decisions, if you will. So it's all about helping you making simple decisions and monetizing your portfolio. What we've done also is in terms of collaboration, and this is a big part of it all, we took the view that, albeit we're very disruptive in what we do, we will not disintermediate the existing ecosystem or the existing banks, if you will, by trying to go on peer-to-peer lending for day one. What we understood is that the best way to go forward, especially in capital markets, is through what we call disruptive collaboration. We're trying to pick up the best of breed with the best practices that are still in this ecosystem, and there are a few of them, and collaborate with them in order to enable this thing to work. And so we're collaborating with Barclays, with Bank of New York Mellon, to deliver this value for you. And basically, that's it. Now I think we're very much open to questions and discussions. And Mike, over to you.
Yeah, thanks, Boaz. Just for the benefit of everyone, can you maybe give us a couple of examples how this works and on a portfolio basis? Like if you own, for example, a Tesla security, or if you own an ETF, how much can you really make of it?
It's a great question. So first of all, I think let's take a step back. For people who joined us just now, why do you want to lend? You get an extra value, a monetizable value, but moreover, you get an informational value, and that's a key issue. What is the informational value? Well, to quote one of our biggest client, he says very nicely, it's a very big family office, that up until they had ShareGain, they had a 330 degrees view of their portfolio. What does that mean? They knew everything bar a specific angle, which was securities lending, what's happening with their portfolio, who's lending it, who's borrowing it, if indeed, or the stocks as a whole, what are the lending rates, and why are things moving? With ShareGain, they're getting the full 360 view of their portfolio. And that informational value, who's lending, who's borrowing in real time, what is the utilization rate, and so on and so forth, was key to their decision to wanting to be a ShareGain client. Now, going back to the monetizable value and to Mike's question, how much can we make from it? Well, it's very much dependent, it's supply and demand driven. How much you're going to make of it, how much is basically dependent on how much borrowers are willing to pay for it. Now, why would someone borrow a stock? Well, every strategy that involves short selling a stock, be it for arbitrage strategies, enjoying from its depreciation or anything of that sort, requires borrowing against it. Also, avoiding failed settlements and other trading strategies requires borrowing against it. So the price is demand-driven or supply constraint-driven. That's it. There are great examples. We always give the Tesla example because everybody knows Tesla. It's a currently at about $50 billion worth of a company in terms of market cap. At the peak of last year, around November, its lending rate was 15%, 1.5, and it trended throughout 2016. So had you as an investor in Tesla, and that's a great, for instance, it's a great example. Had you had that stock from the beginning of 2016, where they traded around $200, if I'm not mistaken, 220, you would have gone from 220 to 270, 190, and now to 370. So about 80% appreciation of the asset, but also gotten about an average about 6% of a dividend, what we call a lending rate, had you lend that stock. So call it an extra dividend, call it whatever you want, but that's another 6% pickup. Why was it so in high demand? Different reasons. But at the end of the day, as what we call a bit of a more long-term investor that is not in for the very short trading, you could have gotten another very nice pickup, and that would mitigate some of the volatility. ETFs, as Mike said, that's a great example as well. The ETF space is a very interesting space. ETF, exchange-traded funds, for those who are not aware with it, it's basically it's a financial tool that tracks indices. An ETF, because most of the institutional world today holds ETFs, doesn't hold ETF directly, but actually all the constituent stocks in general. Why? Because the custody fees of the constituent stocks are actually lower than the management fees of the ETF. So you've got, but on the other side, from the demand side, a lot of hedge funds, for instance, are using ETF as a very neat and efficient trading tool. And that structural problem has been growing every year. Every year, more and more, there's higher demand for ETFs versus shorter supply, or supply constraints on the other side. And that's why most ETFs, outside the ones who are tracking the main indices, are trading above 1.5% in terms of lending rate. Now think of that. Tracking an index like the NASDAQ Biotechnology Index or the MSCI Emerging Markets and having a pickup of 1 or 2% every year just by lending it. That's a great result. That's it, actually.
Speaking about disruption and collaboration, can you give a few examples of financial inclusion? Because that's what we started from, because we had a 200 million portfolio and we were excluded from that market.
Yeah.
But we had a lot of specials here which could lend at a good rate. Can you give an example of how ShareGain changes that? In terms of that, will all the family offices be included? Will all the individuals be included? Can you elaborate on that a little bit?
Yeah, so as we said, let's talk a bit about the numbers game. When we talk about the $2 trillion industry, we talk about what is on average on loan 365 days a year. And that's a big number, 2 trillion. But in capital markets, it's a drop in the ocean. The more interesting number is about 30 trillion. What's a 30 trillion? It's more or less securities that the value of listed securities that are currently sitting idle, collecting dust instead of collecting income. And this is the market that belongs to retail, to family offices, to wealth managers, private banks, and this is the market that we're actually tapping. And if you're looking at the existing number, the existing market, the $2 trillion market that the institutional world is enjoying today, well, that generated about $9.2 billion in revenues last year. $9.2 billion revenues all went to the institutional world, instead of, for instance, our pockets.
Good. So thank you very much for coming. If you have any questions, we'll be gladly open for them. Yes. Go ahead.
Go ahead, whatever. That's a great question. If to repeat to someone, to everyone who hasn't heard, because we're tapping such a huge market, and it always begs the questions: won't be self-defeating? Won't we actually lower the rates, lending rates of ourselves, and lower the income per stock or lending rates per stock? The question for that is very simple, and it's the answer. Pre-08, pre the financial, the global crisis, the lending market, the on-loan market was double, 4 trillion. And that 4 trillion actually had an average lending rates higher than they are today. And why is that? Because there were more institutions actually lending that now, because of the opaqueness and the lack of transparency and the lack of control, have taken a step back, especially post the global crises. But more importantly, there's a lot of pent-up demand in the system that can actually tap into that because of the lack of automation, because of the lack of control, because of the lack of transparency. And we believe that with ShareGain, it's a game of large numbers. We can definitely, by opening up, by delivering that automation and that transparency and that democratization into the ecosystem, we can get it back into the numbers that it was. And let's wait. If we get to 4 trillion and we get to that market share, then I'm very happy. Let's see the rates. But up until then, it will take a good few hundreds of billions to actually influence the price dynamic.
Thank you. Great concept, and I think I'd sign up straight away. If there was not a barrier of my funds being with a pension fund, how do you go about lobbying and unlocking that potential by working with regulators, etc.? Because that's one of the bigger hurdles for you to tap into that 4 trillion or whatever the market is, isn't it?
Yeah, so most pension funds themselves actually, they have the ability to access the incumbent market. Some of them choose not to. Because again, because of their fiduciary duty to their own investors, can't really track the lack of transparency and the lack of and the problems that this existing ecosystem have. But a lot of pension funds are actually doing it today. The problem is that these pension funds have is that you don't really have a great deal of control on what they're doing and not a great deal of transparency. Actually, how do they optimize the processes?
Sorry, can I rephrase the question? How do I access it as an individual where my funds are in a pension fund? How do you allow consumers to use your product by leveraging pension funds as your channels or partners or whatever? So not helping pension funds, help me to do, or help yourself do business with me by working with them.
Yeah, so in terms of what we can tap into today is assets that you hold directly. If you hold them through an asset manager, then the actual asset manager is what we call the beneficial owner, or the pension fund is the beneficial owner of the assets. You don't own the assets in your pension fund. You own rights into that pension fund, and so the pension fund becomes the beneficial owner that can enjoy from it. But if you, for instance, have what we call in the US, in the UK, a SIP or a self-invested pension funds, then you can do it through ShareGain. You can opt into ShareGain. We're more or less bank agnostic, if that's the case. Thank you.
Thank you very much for this. Thanks.
Thank you.